I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. Go to wealthtrack.com for more information. This week on Wealth Track, economic and market lessons from Wall Street's top strategist. Financial thought leader Francois Trahan describes the new era of uncertainty, why so many of the old economic rules aren't working, and what has replaced them as market drivers. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack at the Museum of American Finance in the heart of the financial district on Wall Street. No matter where you look, there is mounting evidence that the global economy is slowing. Research boutique Wolf Trahan pointed out recently that most global leading economic indicators are in contraction territory already. There are a few exceptions, such as Norway, Denmark, and the Czech Republic, which are still showing signs of expansion. But leading indicators in economies such as India, Japan, Germany, and the U.S. appear close to contraction, and in countries ranging from Russia and China to France and Turkey to South Africa and Australia, they are there already. The slowdown is being reflected in world stock markets. As independent research firm Strategas reported recently, the trend has turned negative in 19 of the world's 20 major equity markets, including the U.S. That falling confidence plus sluggish consumer spending and a struggling housing market have caused economists across the globe to slash their forecasts for this year and next. In the U.S. alone, economists have gone from a February consensus forecast of 3.2% GDP growth for the year to the current median forecast of 1.6%. And even that might be too high. In the first half of the year, the economic pace slowed to a sluggish 0.7%. Even the Federal Reserve has been dramatically behind the curve. In February, the Fed upgraded its growth forecast for 2011 to a range of 3.4 to 3.9%. Needless to say, that is far above what it is forecasting now. Why have the vast majority of economists, including those at the Fed, been so wrong? This week's Wealth Track guest is one of the few economists who have gotten it right. He predicted this year's global slowdown and commensurate market dangers here on Wealth Track nearly 2 years ago. He is Francois Trahan, Vice Chairman, Chief Investment Strategist, and Head of Quantitative Research at Wolf Trahan. He has been ranked the Street's #1 portfolio strategist by institutional investors for the past 3 years. He is also the co-author of the recently published book, The Era of Uncertainty: Global Investment Strategies for Inflation, Deflation, and the Middle Ground, which I highly recommend. Trahan believes the economy is now fundamentally different from what we grew up with. I asked him what's changed.
Well, I would say there's 3 main things that are dramatically different. So trends that we had in place for several decades that have now changed. So we had consumers willing to take on credit and debt for 70 years in the US, and since 2008 it's been the opposite. And what the political landscape shows you, I think this summer with the debt ceiling debate, is that the word debt now has a negative connotation attached to it. So we have consumer deleveraging, which is different than anything that I've experienced certainly in my career. Government deleveraging or government austerity people think is a bad word. I call it reality. It's already happening at the state and local level. So if you look at government payrolls over the last half century, what you see is that for 50 years, month after month, governments would hire more and more people.
And this is local, state, and federal.
Exactly. And since 2008, almost every single month, what you see is governments are shedding labor to address their budget issues. So that's dramatically different than what we had in the past. And then the last one, I would say, is that the Fed is now ineffective. 15 years ago, when the Fed cuts rates, the economy improves. When the Fed raises rates, the economy decelerates. When the Fed funds rates at zero, there's just not a whole lot that the Fed can do. So to me, that makes today's backdrop dramatically different than what we've all experienced in our careers.
So why is it that the Fed is not effective? What's changed to make it much less potent than it has been in the past?
Well, I mean, what haven't they done at this point? They've taken the Fed funds rate down to zero, and that's the most powerful tool they have. And I think what QE2 teaches us is that we've reached the limits of monetary policy, because they thought QE2 would be good for the economy. Unfortunately, what it did is it led to a big decline in the US dollar, which meant a big rise in everything we import. The price of gasoline, heating oil, clothing, food, everything sold at Walmart. And what it did is it imposed a tax on consumers. So something that they thought was a form of easing ended up really being a form of tightening, in the form of higher inflation. So I think we've just reached the limits of what the Fed can do here.
Let's talk about inflation, because you think that that is the key variable to understanding what's going to happen in the economy and the markets. And you call inflation the new Fed funds rate. Explain that.
Well, as I said earlier, 15 years ago, the Fed changes the Fed funds rate, and that's what really determines the cyclical outlook for the US economy. The Fed funds rate is zero today, so it can't play that role. And what you find is that it is inflation that is starting to play that role. Inflation went up last year, and now the economy is slowing. Inflation goes down, what's going to happen is consumers are going to find themselves with more money in their pockets. So I'm not a believer that deflation is the boogeyman that a lot of people believe it is, a lot of economists believe it is. I think if the federal government can't put money in consumers' pockets because they're broke, and the Federal Reserve can't do anything, one way to do it would be to sink commodity prices. Get oil prices to come down to $40 a barrel. Everyone around the country all of a sudden is going to find themselves with more disposable income. So to me, that is one way to help consumer deleveraging, to help people meet mortgage payments, credit card payments, et cetera. So, inflation, CPI, has become the new Fed funds rate.
Now, if you talk to the Fed, for instance, the Fed would say, number one, yes, consumer prices, the core inflation has gone up over the last 6 months consecutively. But it's still well within our target rate, so therefore it's not really penalizing us yet. You're saying not so, that inflation is a real concern now.
In my family, we eat food, we drive cars, we heat the house, we wear clothing. So nominal CPI is what matters to consumption. It's not core CPI. I understand why the Fed looks at core, and historically the reason why it made sense in the 80s and 90s is because the US economy used to be the price setter of commodities. So if you're Fed chairman of an economy that sets prices for commodities, you're going to think of commodities being noise on your growth. So you're going to say, let's look at core inflation trends. But that world ended a decade ago. And so I think it's time for the Fed to acknowledge that and to change the Fed mandate. In my opinion, that's the first step that they should do.
And the Fed mandate being this double mandate of full employment and stable prices, you're saying that is no longer applicable.
It all depends on how you define prices. I think core inflation is the wrong benchmark. I think nominal inflation is the right benchmark now.
So what should they be doing now to target nominal CPI?
What they would want to do would be to limit runaway inflation. And so you'd want to limit a big appreciation, if you're targeting nominal CPI, a big appreciation in commodity prices. Because when commodity prices go up, people pay more to fill their gas tank. They have less disposable income left in their pockets. And so, it would be targeting nominal as opposed to core trends.
Right.
It would be targeting things that actually
that?
people consume.
So how does the Fed target nominal CPI?
Well, you raise rates when inflation goes up, and you slow the rate of inflation. And so you're basically, preventing inflation from eroding people's pockets. That's the way to think about it.
So right now then, what they should be doing is raising rates?
Well, we're staring at a downturn. So think about it this way. In the last year, the Fed did not raise rates. But we had tightening in the US economy nonetheless, because inflation went up.
Right.
That's a form of tightening. So whether you do it with short rates or you let the markets do it, it happened regardless. So you can do it proactively, or it can be out of your control. I mean, that's the choices for the Fed as I see it.
The vast majority of your Wall Street peers completely missed the fact that this economy was going to slow as much as it has this year. And you were dead on as far as your forecasts and your predictions that in fact the economy was in more trouble than people realized and that it was going to slow. So you say that what we're witnessing is the death of traditional economics. What's dead about traditional economics? What are the most significant changes? What are your peers missing that you see so clearly?
It's not just Wall Street. I mean, it's the Fed, it's the Congressional Budget Office, it's everybody who's been trained in economics. When you're trained in economics, you're trained to look at tools that have worked over a long period of time.
Right. Post-World War II.
Post-World War II.
Right.
So slope of the yield curve, post-World War II, is a fantastic predictor of the economy. Except when short rates go to zero, what you find studying Japan is that the slope of the yield curve loses its predictive abilities. So a pretty good example, the slope of the yield curve in Japan has been steep for 20 years, and the Japanese economy has been horrible.
So, and when we talk about the slope of the yield curve, we're talking about what interest rates are from Treasury bills, for instance, up to 30-year bonds.
Correct. So the short end to the long end.
Right.
And when official rates go to zero, because it's basically the short end that tends to dictate the slope of the yield curve, what you find is it's just not helpful at forecasting GDP any longer. So economists, I'm a trained economist, we've all been taught to look at the slope of the yield curve, and it served us well. It worked very well for a long period of time. In today's world, it just does not work. So the message you're getting today from the slope of the yield curve is it's still steep. The economy should be great. Unfortunately, it is not.
All right, so we throw that out of our toolkit.
Well, one thing that we found is that you can restore its effectiveness. When the Fed takes the Fed funds rate down to zero, or the BOJ does the same with official rates in Japan, the slope of the yield curve becomes meaningless. But you can restore its efficacy by doing one thing. Instead of using short rates, replace that with inflation. So if you replace that with inflation in the US, your short end is no longer zero, it is now 3.6. Your long end, you look at the 10-year Treasury bond yield, is now 2.
So it's inverted.
It's inverted. So the economy is going into a slowdown, a downturn, possibly a recession. So that's how you restore the efficacy of the yield curve.
All right.
Corporate profits, there used to be a strong relationship between corporate profits and employment. And that broke down about 10 years ago. So in a GDP model, you would have corporate profits in there. And prior to 10 years ago, corporate profits went up, employment went up. That created economic activity. That doesn't work any longer.
So why doesn't it work? What's changed?
It's globalization. Companies are still generating profits and it leads to employment. It leads to employment elsewhere, unfortunately, in today's world. And so if you're trying to forecast US GDP, I think you're going to err basically on the side of error. Much like the economics community has done this year. They were expecting this year to be a great year for growth. Mm-hmm. And in the first half, we generated 0.6% economic growth in the US. The expectations were 3+. That's not a miss. A miss is expecting 3 and getting 2.7. It's enormous.
Another thing that you've said is that in a slow economy as we have now, that employment is absolutely key, and it's a key driver of the economy. And so now we have a situation where we've got a slow economy, and obviously we now have 2 consecutive jobless recoveries. So what does that tell you about the future for the economy right now?
It's not just a slow economy. I would say it's a world where you don't have credit. What's unusual about this recovery is that consumer credit hasn't recovered.
Right.
It's gone down despite the fact that the economy grew a little bit. And so when you don't have credit, and our economy is 71% consumption, so if you don't have credit, it means that you're that much more dependent on employment than you were historically. Employment's always been important, but its importance gets magnified when credit is hindered. And so today we know credit is hindered. It means that if we can't create jobs, we just can't grow the economy, period.
So your outlook for the economy right now is what?
Atrocious. Basically, I think the stock market is beginning to price in a slowdown. With the stock market going down, bond yields moving lower. You look at sector leadership in the marketplace, utilities is the top performing sector in the S&P. Not something I've seen very often in my career, not a good sign of things to come for the US economy. To me, people don't like to call this a double dip, but I think you call it what it is. You look at all these economics charts, they had a dip and now they look like they're rolling over. And so I don't know if we'll meet the technical definition of a recession, which is 2 consecutive negative quarters, but it's clear to me that we're going to see negative GDP in the US.
Let me talk about a little bit about your book, and which is called the Era of Uncertainty: Global Investment Strategies for Inflation, Deflation, and the Middle Ground. And I happen to be delighted to write a recommendation on the book cover for it as well. And one of the things about the era of uncertainty that you talk about is that we better get used to the fact that we are going to see these tail risks, that we're going to see events, kind of outsized events that are going to affect us. So why is this era of uncertainty, this is going to be our future?
We're already in it, in my opinion. So you look at the last decade, we've had 3 boom busts now. If you look at the 50-year period prior to that, you didn't live through a 10-year period where you had so many boom busts. You remember in the 90s, we used to believe that you could extend these business cycles forever.
Goldilocks economy.
Goldilocks economy, which really is the anomaly, in my opinion, to a certain degree. There were special circumstances explaining it. So now we're vulnerable to shocks taking place around the world, and it's even more true for the stock market than it is for the U.S. economy. The U.S. economy exports 12% of GDP, but the stock market derives 40% of its revenues abroad. So stocks are much more susceptible to the rest of the world than the U.S. economy is. So you have to take that into consideration. Last year, events that initially started in Greece showed us that we weren't impervious to things taking place, in a country that most people in the U.S. have never been to. When you're going into a global slowdown, you have to start thinking about what can go wrong. What is the weakest link that will break? And it's not just, the weakest link in the U.S. Is it going to be the muni market? Is there a pension crisis? Is there a budget crisis? But you have to compile a list of what can go wrong around the world.
So give us, your top candidate for what's the weakest link now that could affect us.
There's a long list of potential candidates. I would say Europe, I think, is very vulnerable. And so I wonder if the euro will exist a year from now in its current form.
Seriously?
Yeah, I would put strong odds that it does not.
So what would substitute? What would be substituted for it if we don't have the euro? Or maybe fewer participants? Or?
Well, fewer participants is probably the likeliest scenario. Maybe Greece drops out.
Right.
Who knows? Maybe Italy drops out. Who knows?
Francois, listening to this, I feel like I should get into my bunker and just go into cash or treasuries. And in fact, as far as, you're, an investment strategist, top-ranked investment strategist. So the strategy that you have been recommending is what you call the safety trade. So tell us about what strategy you're recommending right now to your clients.
It's the same thing. I think what has worked will continue to work.
Meaning
stability, safety, defensiveness. So when investors get a sense that the economy is about to slow, what they do is they gravitate towards stability. So in asset allocation, it's away from stocks toward bonds. So the Treasury market has done remarkably well this year because investors have flocked towards stability. At the sector level, I talked earlier about the utilities sector being the top performing sector in the S&P.
Year to date,
followed by staples, followed by healthcare. So 3 sectors that offer relative stability for investors.
Right, consumer staples, the things that we need all the time. Right?
They're the only 3 that are up on an absolute basis as well this year. You look at the Treasury market, it also, the 10-year Treasury bond yield trading as low as 190.
Literally, except for you and a few other people, most people have, I think I've been hearing this for like 4 years. The Treasury market, is just, it's overvalued. It's been a vilified, security.
And yet, going into a downturn, it sounds pretty darn good.
Right.
So that's a phenomenal return this year. Those are all things that are part of a portfolio that protects you from a downturn in the economy.
What about gold?
Well, gold is kind of the anti-currency.
Right.
Gold tends to work best when you have inflation. We've had inflation. I think in a global downturn, inflation will probably wane, which would be the normal pattern. So instinctively, I think gold's best days are probably behind us for a while. But in a world where nobody likes the euro, nobody likes the dollar, gold's a pretty good alternative. So I don't know that it will go down a whole lot, but it's not at the top of my list any longer.
What about currencies, other currencies other than the dollar? The Swiss franc, for instance, the Swiss are saying that they're going to cap the franc's appreciation against the euro. So are there other alternative currencies as well that offer stability that are still accessible to us?
There's not that many because the currencies from countries that seem fairly stable also happen to be very cyclical in nature. Australia, Canada, New Zealand, etc. So I think what might be the bigger surprise here, much like bonds have behaved fairly defensively, I think the US dollar might just behave somewhat defensively going forward. So I think it's probably time to be dollar bullish at this juncture. In a global slowdown, people flock towards stability, and the US might look better than other parts of the world, believe it or not.
I'm so surprised to hear you say that, because I know for a long time, and correctly, you have said that the dollar would depreciate as
Correct.
it has and lost its value.
Yep.
But now, again, in times of trouble, it's still...
In times of stress, I think it is still, when we've seen this in big down days in the stock market recently, what you've seen is the dollar has appreciated. And what that says to me is that a lot of investors still view it as a relatively safe asset. Same thing as treasuries. Might not last forever. I think in 2011 it will work.
So let's talk about 2012, because one of the things, again, listening to you, instead of me thinking that I should just be all in safe assets, that what this is setting us up for, this slowdown in the global economy, is setting us up for a recovery. So why are you more optimistic about 2012 than you were about this year?
Because we had tightening, going into this year. Central banks around the world were tightening policy, and in the US we had tightening in the form of higher inflation. So we've seen Brazil now cut rates, and it's one central bank, but it's central bank from a pretty big country, and I think you're going to see a lot more going forward. So I think you're going to start to see the beginning of an easing cycle around the world. And in the US, I suspect we will get easing in the form of lower inflation, stronger dollar. Will bring about lower commodity prices, put money in consumers' pockets, and I think all that, sets the stage for a better economy. It might not be a great one, but stocks are priced at the margin. And so when I say 2012 will be a better year than 2011, 2011 might not be a good year at all. So the bar is going to be pretty low, but I would say right now the early evidence for me looks pretty good on 2012. If you get CPI to come down in the US, you get central banks around the world to cut rates, you're going to be putting stimulus into the system, and I think what you will have next year is an economic recovery. That starts later in the year, but something that stocks hopefully begin to discount earlier in the year.
Right, so stocks do tend to discount things earlier in the year. So when do you start, making that sector rotation into more cyclical investments?
You do it when leading indicators of the economy find the footing. So right now they're all falling, pretty significantly. So when you feel like that turning point is upon us, that is the time to move more aggressively into equities. But into the cyclical sectors of the market, the financials, the technology, those types of stocks that have lagged this year. And that will be the time, I think, to sell your treasuries finally, and to, again, consider more cyclical currencies around the world. Between now and then, I think it's going to be pretty painful, unfortunately.
Financials. We've talked to a well-known money manager who has bet very heavily on financials. Would you touch them right now? I mean, do you mind being early, or do you think it's like way too early to be in financial stocks at this
I think
point?
it is still too early to be in financial stocks. So worst performing sector year to date, down 24, 25%, something like that. What I'm concerned with is that the worst part of every cycle is often the last part of every cycle. And so I don't think there is a fourth quarter rally coming this year. I'm worried that it might be a fourth quarter meltdown, to be quite honest. And so financials, they've come down a lot, but they're very cyclical. And they are stocks that are associated with a lot of the ills that we have in this country. And so I believe it is still too early. I think that's a 2012 story.
The one investment for a long-term diversified portfolio that all of us should own some of, and I will say in the past you made a very good commodity call, where commodities were a very good asset to buy, and also energy was another asset that you recommended. So what would you?
Yeah, I still like that story long term. In
energy.
In the long term, yes, I believe the emerging market consumer story. But we're talking about something that's going to last 10, 20 years. The problem is that we're in this boom bust type of environment, and it's difficult to think that way. So in my opinion, if you're trying to protect your portfolio, and you're trying to think about what's going to happen in the next 6 months or so, I would say stick with treasuries. That's one of the best performing asset classes so far this year, and I think that's where you can make absolute returns in this type of backdrop. There's a lot of ways to play the investment cycle and the slowdown, but that's one way that's easy for investors to do it.
And when you're talking about treasuries, 10-year treasury, I mean, would
Sure.
you go out?
10-year treasury, trading at about 2% today. The 10-year Treasury that everybody told us was about to rise, the Treasury yield was about to rise significantly earlier this year, it's behaving in a very classic manner. Going into a downturn, it is rallying. And so stick with what works.
So Francois Trahan, it's so great to have you on Wealth Track from Wolf Trahan, and also with your wonderful book, The Era of Uncertainty. Thanks for joining us.
Thank you.
I agree with Francois that uncertainty and volatility are going to be two of the key and constant storylines of our financial lives. So our action point this week picks up on his theme of sticking with safety in at least part of your portfolio. This week's action point: have a portion of your savings in safe and liquid investments. That means in much maligned U.S. Treasuries, no matter how low the yield, in TIPS, those Treasury inflation protected securities that will keep up with inflation, and cash equivalents, even with practically non-existent yields. Safety nets are always essential no matter what the market conditions. I hope you can join us next week. I will have a rare interview with First Eagle Fund's investment great Jean-Marie Eveillard, who will discuss his personal perspectives and strategies in today's turbulent markets. For those of you who want to see our Wealth Track interviews ahead of the pack, we have a new opportunity for you. Subscribers can now see our program as early as Thursday morning on our website, along with timely interviews exclusive to Wealth Track web subscribers. To sign up, go to our website, wealthtrack.com. And while you're there, if you haven't done so already, please fill out our confidential and brief survey for Wealth Track viewers. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.